Hello everyone. In today's video, we are going to delve into the psychology behind investing. Everything has a price. Whether you are eyeing a new car or considering buying a bigger house, they all come with a price tag. You have to pay a certain amount to acquire them, and once you own them, maintenance costs come into play. This is known as the cost. Investing operates on the same principle. When investing in stocks, the price of the stock and the transaction commission represent the costs, while the fluctuation in stock prices represents the risk you take on. Imagine if you foresaw the bright future of Nvidia 10 years ago and invested all your wealth in it. You might be very wealthy today. However, the journey was anything but smooth. Nvidia stock witnessed two major drops of over 80% and three of over 50%. In such intense fluctuations, how did you convince yourself to hold on? What would you say to your family when your investment shrank by 80%? This is, of course, an extreme example, but as long as you invest in the stock market, fluctuations are inevitable. For instance, many people are bullish on tech stocks now, but 23 years ago, the same was true. What happened after the dot-com bubble burst in 2000? The Nasdaq 100 index, representing tech stocks, declined by over 80% and took nearly 16 years to recover to its previous peaks. Investing can excite because it has the potential to create wealth, but it comes at a price. All investors must endure market volatility, which you must see as the cost for a bright future. Some young investors might think they can dodge the downturns and capture the uptrends. We'll continue discussing this topic later, so please keep watching. We often encounter the mentality of comparison when you're happy about your $100,000 year-end bonus, but become unhappy upon discovering that a disliked colleague, Lee, received an even larger bonus. Capitalism excels at creating wealth and envy. Social media and the internet have amplified these sentiments, constantly displaying others' success stories and rapid stock leaps. And even those who know little about investing, who suddenly strike it rich with Bitcoin investments. The financial market has a term for this called FOMO, or fear of missing out, which describes this mindset. Remember, never risk losing what you have and need for something you don't have and don't need because of pursuit. We cannot predict the future, but we can prepare for it, so we can withstand catastrophes. Whether it's the Great Depression of the 1930s, World War II, financial crises, or the recent COVID-19 pandemic. These events had a massive impact and were mostly unpredictable. The markets are always full of uncertainties, so maintaining an optimistic attitude and preparing mentally and financially for potential disasters is crucial. Economists found that the gap between dreams and reality can drive some to extreme gambling behaviors, such as the lowest income families spending over 4 times more on lottery tickets than the highest income families. When you think someone's behavior is crazy, try to see it from their perspective. Maybe for them, that's how they chase their dreams. Similarly, people have different investment goals and strategies. Especially when you are young, you should focus on how to accumulate capital rather than preserve wealth. In conclusion, if you are not willing to accept market fluctuations, you cannot become wealthy in the market. Remember, do not envy others, as their actions may not be suitable for you. You can't always try to predict disasters. Instead, prepare yourself to weather the storm. Maintain optimism, and this will help carry you through the financial ups and downs.